This is your last chance to buy SoFi before this happens. Despite the big miss with earnings, SoFi is about to show the world that they are a force to be reckoned with. Go ahead and hit the like button right now to let me know if you want to see more of these types of videos. Since going public, SoFi stock may have taken a beating, but the company has been nothing but a growth story. Quarter after quarter, they've demonstrated their ability to grow even when the rest of the financial industry is lagging. Even when their original business plan blew up in their faces with the moratorium on student loan payments, SoFi not only found their way to keep growing, but drastically diversified their revenue streams and is in a stronger position than they have any right to be in this challenging business environment. Despite all of this, they missed big on earnings this quarter with a loss of 29 cents per share versus an expected loss of 7 cents per share. I'll get to why that happened exactly in just a moment, and why all that is going to change when they report results next quarter. It's all going to change because SoFi will be profitable for the first time. Now, I've been talking about SoFi for a long time, and I've made no secret that I hold the stock in my personal portfolio as a long-term investment, so I am not unbiased, and you should do your own research and come to your own conclusions. Anthony Noto has been predicting profitability by Q4 of 2023 for quite some time, and normally I am a perennially pessimistic pundit when it comes to predictions of profitability. But based on the evidence, the accounting moves made this quarter that accounted for the outsized loss, and the consistent growth of SoFi, I think there's an extremely high likelihood that the company will report their first profit in Q4 of 2023. Profitability is obviously a huge moment, but more than that, the story of SoFi is changing. It is changing from an upstart company that has been growing revenues without profit to a profit growth story, which is going to have a huge impact on the stock price going forward. This is all happening because they have successfully executed on their productivity loop, which looks a lot like the Amazon flywheel strategy. For the first time in company history, all three of their business segments, lending, technology, and financial products, have all made positive contribution to the bottom line. In fact, 67% of growth in adjusted net revenue dollars was from non-lending business. It wasn't the resumption of student loan repayment driving growth this quarter, it was financial services and the technology platform segments. For the first time, financial services eked out a $3.3 million gain versus a loss of $4 million in the prior quarter. The SoFi technology platform contributed a little bit more than $32 million to the bottom line, based mostly on improved margins, roughly doubling the profits they made from this segment in the prior quarter. The lending segment has long been profitable, but they have turned a corner in the character of dollars generated. 77% of the adjusted revenue in the lending sector was net interest income, not origination fees on loans. That number has grown by 90% over the last year to top $265 million. Net interest income is now almost 2 times their expenses of $139 million. This is a massive change in the character of the dollars that they are earning. The shift is occurring because, unlike prior years, 65% of SoFi's loans are funded by bank deposits, cutting out the very expensive middleman when it comes to raising capital for loan originations. They no longer have to borrow all of their money from third parties or fund loans with ill-timed security sales. With $15.7 billion on deposit, the need for expensive third-party funding is going to decrease further over time, and interest income is going to continue to increase. The growing deposit base and high balances of SoFi customers is also driving strong growth in financial services as well. SoFi Money has seen 53% year-over-year growth to 3.1 million accounts. The high credit quality and high balance of the average SoFi member is driving financial services more broadly as well, with net revenue for the sector as a whole growing 142% year over year. This is impressive growth, but the fact that financial services was able to profit at all is more impressive. SoFi Credit Card and SoFi Invest are still running at a $100 million annual loss rate as SoFi scales acquisition and marketing. So everything, and I mean everything about the business looks great for SoFi. So where did the 29 cent per share loss come from, and why was that a lot higher than analyst expectations? It came from something called a goodwill impairment, which SoFi did not do a good job of explaining on the earnings call. A goodwill is an intangible asset that arises as a result of one company buying another for a premium value. This is related to the acquisition of Technisys in November of 2022. SoFi Technologies' acquisition of Technisys was the largest bank purchase of an information technology company since 2012. They definitely paid a premium for the company, $956.8 million to be exact. SoFi has strategically chosen now to recognize that write-down of the value of that deal by $247 million. Based on generally accepted accounting principles or GAAP, they could have waited until next quarter to recognize that loss, but it would have overshadowed the achievement of profitability. It is a non-cash charge. It has no impact on current revenues, their deposit base, or the actual dollars flowing through their company. It is just an accounting recognition that the fair value of Technisys is less than what they paid for it. The reason you don't see analysts panicking over the larger than expected loss for SoFi is because this is a normal practice in accounting and goodwill impairment charges happen all the time. The most famous example is probably the $54.2 billion impairment charge for the AOL Time Warner merger. This is a one-time accounting adjustment. When that impairment charge is excluded, GAAP EPS goes from negative 29 cents per share to negative 3 cents per share. SoFi was very close to being profitable this quarter, and without the impairment charge, they would have handily beat analyst expectations of negative 7 cents per share. Recognizing this charge 3 months early prevents the write-down from ruining expectations of profitability next quarter. And I don't see a lot standing in the way of profitability for SoFi. Anthony Noto appears to be correct in saying that SoFi has entered a secular growth phase, meaning that the company will likely continue to grow membership and revenues despite economic headwinds like they've done for the last year. For the full year, SoFi is expected to grow adjusted net revenue by 33 or 34%, with a huge improvement in margins on the strength of net interest income, financial services, and the technology platform. There is a huge pipeline for the technology platform. The student loan business is improved much more rapidly than analyst expectations. Deposit growth is set to continue to grow based on the unrivaled strength of the direct deposit program. And so this was a good opportunity for SoFi to go ahead and write down that pesky loss on the acquisition of Technisys. This all adds up to SoFi achieving their first profit next quarter. This will have a hugely positive effect on their stock price, but the extent of which is kind of hard to determine. It really depends on how the market is going to value the stock going forward, and that is really unknown. Does it deserve to be valued as a bank, or should it be valued as a technology company? I think it should be valued as a technology company, and I think that will be reflected in the stock price as we approach the end of Q4. So you have some time to make a decision about whether to buy, sell, or hold this stock before the market really catches up. Let me know how you think this stock should be valued in the comments below. I'm genuinely curious to know your opinion. Thanks for watching, and I'll see you next time.